Now, as we've seen, a firm will develop a cash budget to project how much financing it's going to need at any given point in time. So in the example we've seen, on a month-by-month basis, we determine how much financing we think we're going to need. The next step, though, in the process is to figure out what kind of financing. And by this I mean whether we want to borrow long-term or whether we want to borrow short-term. This selection of what type of external source of funds to use is an important decision to us, because in part it's hard to know exactly from time to time what financing is going to be available and at what cost. It's generally considered desirable to finance long-lived assets, like fixed assets, with long-term financing, like bonds perhaps, or stock. And to finance short-term assets with short-term financing, for example, with a bank loan that might carry us over through some seasonal period. So, in general, an appropriate financing pattern might match the asset life with the lives of the debt that we're considering with that financing pattern. Let's take a look at what this might look like. In this chart, we see three kinds of assets. Here at the very bottom, we have fixed assets, and ignore the things on the right-hand side. Ignore this material over here for the moment. We're just looking at various assets over time. The fixed assets for this firm are rising somewhat over time. In addition, the firm has current assets. Some of those current assets are inventories, receivables, and cash. Those are the principal current assets that the firm is likely to have. But as we discussed earlier, only some of the current assets will be liquidated in the course of the year. Other current assets, like the inventories at Walmart, perhaps, that stay on the shelves all the time, even though they're inventory, they're classified as current assets. The fact of the matter is we never sell the shelves completely bare. So some of those assets, in fact, are permanent current assets, and some of them are the temporary current assets that do liquidate over time, like our tree farm. So in this case, we see in red the temporary current assets, and we see permanent current assets also in blue, which matches with the financing pattern that we have over here to the side. Sort of ideally, all these assets that don't disappear, okay, that are permanent in nature, be they fixed assets or permanent current assets, would be financed with long-term debt and equity. The red portion, that's the temporary portion, that really truly is short-term in nature, it's temporary in nature, we would finance with short-term financing. So we would try to borrow and have stock equal to what we think are going to be the long-term asset needs of the company, and only finance the short-term needs with short-term debt. Now, with that in mind, it's important to consider alternative possibilities. So we've looked at what we think of as perhaps an idealized situation, but it's actually a challenge to figure out what the temporary current assets are relative to the permanent current assets. In other words, do we really know exactly when we're going to liquidate the inventory? We have to be able to meet various contingencies. If we don't sell as much as we thought we would, and we are stuck with some what appear to be more current or at least somewhat permanent current assets, they don't liquidate when we think they will, well, that can be a problem. So the exact timing of these asset liquidations can be uncertain to us. It's also difficult to judge in the future what the costs are going to be of short-term financing or long-term financing, or even if short-term financing will necessarily be available. Our bank may be willing to loan us money on a short-term basis currently, but if the economy turns down and the bank itself has problems, they may suddenly decide that we're too risky and refuse to extend, to roll over our credit lines or our short-term debt. If that happens, we could find ourselves unable to borrow money when we need it. So short-term financing has some additional risk associated with it. If we are concerned about that additional risk, we might consider using more long-term debt than we otherwise would. And the reason is, if we lock in a long-term loan, we know we're going to have that financing available in the future, even if our projections don't work out exactly as we hope they would. So we might use the long-term capital, long-term debt, stock, to, as we've seen in the previous slide, to finance our fixed assets, which are long-term, and our permanent current assets. That's not a change from what we saw before. That's exactly what we were financing previously. But in addition, we might want to use long-term financing to finance part of the temporary current assets as well, so that if they prove not to be as temporary as we would like, we don't have a problem of getting financing when the time comes. If we do that, our little graph or chart might look more like this. So in this instance, we see the fixed assets, the permanent assets in blue, permanent current assets in blue, still financed with long-term financing. But we also have these areas in here, part of our temporary current assets, that are also being financed with our long-term debt. So we're using less short-term debt in the capital structure in order to lock in some safety there and not be as worried that we won't be able to get short-term financing when the time comes if we have a problem. Having said that, while on the one hand we might opt to use more long-term financing, the fact is some companies can't in particular, have trouble borrowing long-term. They might be able to issue stock, but they're going to have difficulty borrowing long-term. They're going to keep larger cash balances in general so that they don't run out of cash. But they're going to be in a situation where they have to, in fact, if they borrow, they're going to have to borrow short-term. They rely on bank debt. They may rely on trade credit. So they use when we talk about trade credit, we just mean that the vendors who are selling to them may actually be financing their inventory. So they buy the inventory and say, bill me, and I'll pay you at some point in the future. Well, effectively, their supplier has become a creditor, and that's trade credit, and it's short-term in nature as well. That may be the principal means of financing for a lot of small firms. One of the advantages of using short-term financing is that generally interest rates are lower on short-term debt than they are on long-term debt. We'll see a little more of that in a moment. We'll see some detail on that. So if we pursue this path, we would use short-term financing to finance our temporary current assets, which we did earlier. That's what we did in our base case, the little red section for temporary current assets. We were using short-term debt. But in addition, now we might finance part of the permanent working capital, permanent current asset needs of the firm with short-term debt as well. So we see a scenario here where, of course, the red portion is our short-term financing. It's not only being used to finance the temporary current assets that we had before, the short-term or supposed short-term assets, temporary assets, but it's also being used to finance some portion of the current assets that we don't really expect we're going to liquidate at all. That's going to be retained, it's permanent current assets over time. And the reason we might do this is perhaps we can't get long-term credit. That's one possibility. Another reason we might do this is short-term financing tends to be cheaper than long-term financing. Having said that, it's also sometimes riskier because banks may decide that they're going to change the terms on which they're willing to lend to us on a short-term basis. This was sort of driven home for many firms in 2008 when there was a crisis, 2008, 2009, a bank crisis, and many banks decided that they needed to be more prudent in their lending, and they actually cut off some of their riskier customers who had borrowed money, and some small businesses actually had to go into bankruptcy because they couldn't get additional financing in the short term, and they hadn't borrowed long term. They borrowed short term, and the circumstances for the bank changed, even if they hadn't changed for the individual firm.